Good morning, everyone. My name is Don Daniel, founder of Pill Method International, a better way to eliminate debt. And today we're in Clubhouse. Also, we're on YouTube, Facebook, Twitter, and LinkedIn. If you want to see these examples, I would suggest going to, let's say YouTube. Go to YouTube, search for Pill Method, and click on the live show if you have a secondary device. We're going to jump right in. And if you have any questions about this subject, raise your hand, come to the stage right now. Even if you don't have a question right now, raise your hand, come to the stage, and be ready to jump in. So, Kurt, I am sending you over the link to our article this morning. I'm also going to put it in the comment section. All right. I'm putting it in the comment section online. All right. So we're going to paste that in there and send it out. I'm also adding it to the chat in Clubhouse. All right. So if you want to have this information, the main information, you'll be able to access it on your own. I would suggest that you study this. This is a good place to start, but there is a lot more. There is so much to this subject. We will not be able to cover it all today, guaranteed. There is so much going on. So I want to start with the very first question here. All right. So as soon as I pin my link to the top, all right, Pill Method. Let's see. Let me see this. All right. As soon as I can get my iPad to, there we go. And ICE 10K.com. Add the link. All right. So first of all, I want to say I am so glad to be back. I am glad to be back. My wife and I were on vacation. We were in Jamaica for the last week, and so we made available to you replays that you could see on YouTube, Facebook, Twitter, and LinkedIn for the time that we were away. But I'm so glad to be back live. We have Kurt Nugent, our producer, with us this morning. I don't know if he'll be able to say anything, but Kurt, whenever you can, jump in there and just tell us how you're feeling about things, being back live, doing live shows again. So folks, let me jump right in first by asking a question, and this is important. This is going to be very important. Have you ever had a class on how mortgages and other loans actually work? A class on the history of mortgages and other loans and how they work and how they affect our finances. Have you ever had a class on it? Put a yes or put a Y or an N. A Y for yes and an N for no. All right. I see a no. I see a no. All right. Listen, you can spell it out, yes or no, or put a Y or an N in the chat. I'm not going to tell you there is a reason why you have not been taught this. Okay. And we're going to go over what happened after the Great Depression. All right. And so Junior B says, it was great to meet you and your wife. It was a blessing. Thanks. A gorgeous book. It's an eye opener. All right. So Junior B, so listen, if you want, give me your full name so I know who you're talking about if you want. But they must have been in Jamaica with us, and I gave them my book. So listen, Kurt, we took some books with us, and we were able to give away a lot of books while we're in Jamaica. And this person obviously was one of them. So great to meet you as well. If you want to tell me who you are, that would be great. Oh, it's Brent. Hey, Brent. All right. Brent, it's good to see you. Listen, good to see you in here bright and early about what and to learn about what's going on here. So Brent, have you ever had a class on how mortgages actually work? There's a reason behind it, I believe, and I'm going to present a compelling argument today as to why I believe There is virtually no education on this subject. Start inviting people in. Hit that little up arrow out of that box there down at the bottom and share this on Clubhouse. If you are watching us online, share this with your friends right now, ladies and gentlemen. And if you want to ask questions, start putting it in the chat now. If you're on Clubhouse, raise your hand and come to the stage. So let's jump in right now. And I'm going to make sure we can see this on our screen. Share screen. Okay, and there we go, screen 3, and there it is. We're going to put that on there. All right, so let's go ahead and jump right into this and talk about this. All right, so this is an article that I found online, and I've presented the link to you so that you can read it on your own. Please study these things on your own. We are expected to use car loans to buy cars, student loans to pay for education, mortgage loans to buy houses and other investment properties. All right. Credit cards. All right. And the education that we've received on these things is inadequate at best. It's not based on the education we received is not based on why these things came into being, how they actually work, and who it actually benefits. Let's take you through a very short story, a history about how this works. But I see a few people in here, and good morning to you all. Fatima, Teresa, Crystal, Ty, Al, Z, all right, and others are coming in right now. Keep inviting some folks in. And again, I'm going to ask this question. Have you ever had a class on how any of these loans actually work and who it was designed to benefit? All right. So we're going to find out the history of these things. The loans that we have today, prior to the Great Depression, did not exist. Before 1936, there was no such thing as a long-term mortgage. It didn't exist before 1936. So let's jump into it. Let's see what the article has to say. So we're going to skip down. We're going to skip down to where we get to the historical context. All right. And stop me at any time. Raise your hand. Come to the stage. Let's talk about it today. Before the Great Depression, all right, the single family home mortgage was a very different instrument. And I'm reading this from this article, ladies and gentlemen, for those of you who are on Clubhouse and you want to see what we're doing, see the article, go ahead and go to YouTube, search for P.I.L.L method. And whoever has it, could you put a link to our show in the chat as well? If you're online watching us on YouTube as well, put a link in the chat for the folks so it'll be easier for them to find. But you can go to YouTube, search for P.I.L.L method, and you'll see the live. Now watch this. All right. Until the 1930s, residential mortgages in the United States were available only for a short term, typically 5 to 10 years. There was no 30-year mortgage. There was no 20-year mortgage. It was 5 to 10 years. And for some terms, it was even shorter, 3 to 5 years. All right. So now, how did this work? Let's talk about this. And it featured a bullet. Now, we call it a balloon payment today. All right. Bullet payments of principal at term, meaning at the end of the term, whether your term was 3 years, 5 years, 10 years, at the end of the term, there was a full payment due on the rest of the balance. All right. Now, how did folks get around this? Unless borrowers could find means to refinance these loans when they came due, they would have to pay off the outstanding loan balance. In addition, most loans carried a variable rate of interest. So that was common practice prior to the Great Depression. You had a short-term loan, and when your term was up, you would just get it refinanced. Now, let's find out some other parts of this thing. What else was going on with these loans? And I'm looking for anybody who's raising their hand. Marcus raised his hand. He wants to come on up. Let's invite Marcus to the stage. All right, invite to speak. All right, Marcus, do you have? Come on up, Marcus. Uh-oh, he put his hand down. Maybe he was just saying hi. All right. Maybe you're just saying hi. Okay, Marcus, good morning to you. Listen, come to the stage anyway. You don't have to talk. Listen, folks, come to the stage anyway. You don't have to talk. When you come to the stage, your presence actually invites more people in. So you're going to be helpful to somebody else just by sitting and listening on the stage. So raise your hand, come to the stage. You don't have to talk. I promise you. All right. You don't have to. All right. So I'll be looking from time to time. Now, I've got this other part highlighted here. All right. It says during the Great Depression in the early 1930s, property values in the United States declined by 50% relative to peak values. See, here's the thing. When people they had to have 50 to 80% down. 50 to 80% down, which means there was a very low debt to let's see, how did it do that? Debt to loan to value. All right, loan to value, very low percentages. All right, so if you got in trouble with your loan, it was easy just to sell the property and get out from under this loan because you had so much money down, you had so much equity in the property. But after the stock market crash, Kanisha wants to come to the stage. All right, invite to speak. After the stock market crash, then property values began to sink. I mean, like big time. Good morning, Miss Kanisha. How are you doing?
Good morning. I'm doing well. How are you?
I'm doing well. Do you have a question about what we've studied so far?
Oh, nope. I am just coming to the stage. I'm listening. I'm a mortgage loan originator, so this is always very, very interesting to know the history of the very thing that I do every day. So I'm listening. Thank you so much.
You are so welcome, Miss Kanisha. So here's what happened, folks. So in the 1930s, the property values began to sink. Holders of these mortgages, knowing their positions were insecure. All right. So the bankers saying these mortgages are now insecure, refused to refinance the loans that came due. See, these people had these loans which were interest only for the most part. They were interest only for the most part. They were variable rate. And every 3 to 5 to 10 years, when the note became due, they would just refinance it. And the banks were happy to get the interest only payments. All right. They were happy to get the interest only payments. Miss Crystal, love it that you're here. Come on up to the stage. All right. So, when they got the let's see, so the banks refused to refinance when it came due. As a result, borrowers defaulted. You would think that the reason why most people lost their properties is because they couldn't make the payments. No. Most people lost their properties during the Great Depression is because they couldn't make the balloon payment. They were used to refinancing. That's what happened back then. All right. That's how they lost their properties. All right. So a wave of foreclosures resulted typically, 250,000 per year between 1931 and 1935. At the worst of the Depression, nearly 10% of the homes were in foreclosure. I have a note here. Okay, on this first, equity lost, no money to pay off the loan, and the banks would not refi. They decided to foreclose. Okay, so at the worst of the depression, 10% of the homes were in foreclosure. In response to these calamities, all right. Thank you, Crystal. Anytime you want, please come to the stage. All right. In response to these calamities, the federal government began investing in the in housing in the housing finance market. It created three particularly important institutions. Watch this now. The Homeowners Loan Corporation, HOLC, which practically none of us have ever heard about. The Federal Housing Administration, the FHA, which we've heard about, it started back then. All right. And the Federal National Mortgage Association, Fannie Mae. That's when all this started. Okay. Now, the Homeowners Corporation, HOLC, raised funds using government-backed bonds. So using government-backed bonds. Now, the Great Depression didn't mean there was no money. The Great Depression meant that there was no money in circulation. All right. If you were doing well, you had money, and the depression didn't bother you. So listen to this. The Homeowners Loan Corporation raised funds using government-backed bonds, used these funds to purchase defaulted mortgages from financial institutions, and then reinstated the mortgages. So the government raised money to buy these mortgages and then reinstated them. How did they reinstate them? Let's find out. Okay. The HOLC changed the terms of the mortgages drastically, converting variable rate, short-term, non-amortizing mortgages into fixed rate, long-term, 20-year, fully amortizing mortgages. Now, what is an amortizing mortgage? It says it right here. An amortizing mortgage is one where the principal is repaid over the life of the loan. Okay. So over these 20 years, you're going to repay the entire amount. All right. Repay the entire amount of the loan so that the borrower does not face a large lump sum payment at the end of the loan. The HOLC ultimately purchased, reinstated, and converted 1 million mortgages. So, what happened? The government stepped in, bought up a bunch of mortgages, reissued them to the same people with long-term amortizing mortgages, 20-year mortgages that would be paid off at the end of 20 years. All right, now here is where it gets interesting. I need you to keep inviting some people into the room now. All right, and I see some people in here with the red with red tickets. Invite other people in. If you have a red ticket, join the Mortgage Syndicate. You're going to get more information like this throughout the week. All right, join the P.I.L.L Method House. You're going to get more information on how loans actually work and how you can save money on these loans, and you don't have to pay all of this interest. Okay, we're going to find out what ultimately began to happen with long-term mortgages. All right. So the Homeowners Loan Corporation, raising funds, bought these mortgages, reissued them with 20-year loans. Because the federal government did not see itself as being in the business of holding mortgages. I need you guys to focus in on that. The federal government is now in the business of lending. They did not want to be in the business of lending. So what happened? Right? That's where it starts to affect us. All right. Because the federal government did not see itself as being in the business of holding mortgages in the long term, it needed to find a way to make these mortgages marketable. They need to make the mortgages marketable. How did they do that? In particular, investors in mortgages wanted assurance that they would receive principal, the full principal balance, and scheduled interest payments. So let's stop right there. This is where mortgage insurance got started as well, to help to make sure that investors see the banks, the government did not want to be in the mortgage business. So the government found a way to create a secondary market. So to create the secondary market, they sold those mortgages so that they could get their money back. But the investors, here's what the investors wanted. They wanted to, they liked the idea of these 20-year mortgages where they could get long-term interest, all right, monthly, all right, but they wanted the assurance they would receive the full principal balance. So if somebody should default, how do I get my money back? That's number one. And number two, and scheduled interest payments. Scheduled interest payments. That means, how do we get 20-year scheduled interest payments? Here is what I'm proposing right here, right now. And we're going to see how this develops throughout this article. How did they ensure that they would get their money? Private mortgage insurance. It started out as government mortgage insurance through FHA. FHA started this whole business of mortgage insurance back then. So the investors could come in and purchase up these mortgages, and the government can get their money back. All right. So that took care of one thing. What took care of the other thing? The scheduled interest payments. Now, what were the scheduled interest payments? Somebody put it in the chat. What were the scheduled interest payments? Somebody put it in the comment section. The scheduled interest payments that the investors were looking for. What does that mean? What does that mean? Put it in the chat. Put it in, if you're watching us, go ahead and put it in the comment section, or raise your hand and come to the stage and answer the question. So we know what it meant, so that they could get their money. There was mortgage insurance, but they wanted assurance that they would get their scheduled interest payments for the entire 20 years. How do you get their mortgage? How do you get their payments for 20 years or close to 20 years? Anybody got any ideas? I have one. Let's make sure that these people do not understand the formula for amortizing a loan. If they don't understand it, if we don't teach it to them, they will continue to pay on these mortgages for a long time, not knowing that they could be done with the mortgage in 5 to 7 years. They didn't know they could do that. There was no education. So all of this was going on behind the scenes. The government is buying up mortgages. They're making it attractive to investors. And investors said, listen, how do I secure my money? Okay, mortgage insurance. We're going to make sure you get mortgage insurance. And then how do I get my scheduled interest payments? We're not going to teach the people how the loans actually work. And most of you, if you would just stop to think about it, have you ever had a class on how mortgages actually work? And that you could save a ton of interest by learning how the whole system worked, so that you can give the bank back their money, or the investors back their money, in a way that makes it impossible for them to charge you all of that interest. I'm going to talk about that in a little bit. So, is this beginning to make sense to you? Now, I need you to also focus in on the fact that the government that was involved in this thing. So, if there was a business to be had, okay, if you know of a business where you have unsophisticated borrowers and you have an idea, and you have a way of securitizing these loans and putting it out on the secondary market, who do you think are going to be the first people to buy up these long-term mortgages? Who do you think who's going to be the first people to buy them up? I'm not saying, I'm just asking a good question. All right? You're putting the laws together. Okay? You're putting it all together and you're making these mortgages available to be bought up on the secondary market. Who's going to buy up the first ones? I'm just wondering. Okay? So, what else is going on? All right, let's take a look. While some private mortgage insurance companies were in the business for this purpose before the 1930s, they were insufficiently capitalized and failed in the early 1930s. Consequently, the government established the Federal Housing Administration, FHA, to provide mortgage insurance necessary for investors to purchase mortgages with confidence. Did you realize that most of the mortgages today, I don't care if you got your mortgage from Chase or you got your mortgage from, let's say, Bank of America, or you got your mortgage from, I don't know, Wells Fargo. Most of those mortgages, even though you pay the bank, your particular bank, the paper is actually owned by somebody else. The bank just becomes a clearinghouse for a funny money transaction, because even though the bank is initially paid for the house and bought your equity, a mortgage investor bought the paper to replenish the funds of the bank. So the bank is not making money from the interest. The bank is making money because they're selling the paper at a discount. Okay, they're selling the paper at a discount, and therefore that's how they're making their money, not from the long-term interest. The investors make money from the long-term interest because we as consumers, we don't understand how a mortgage is actually put together and how it works. So the investors thinking, I am secure in getting my long-term mortgage interest. Because that's why I got into the business. Lord have mercy. All right. So Rodney says money laundering, LOL, at its best. Yeah, I see that's a joke, Rodney. So Rodney is watching us on YouTube this morning. Thank you for being here, Rodney. And for all of you that are watching us on YouTube, Twitter, Facebook, LinkedIn, share this with your people. If you're watching us if you're listening to us on Clubhouse, continue to share this out. Okay. Let me see here. Let me check the insights. Okay, Dorothy, thank you for sharing the room. Master Z, thank you for sharing the room. Can anybody else get a thank you for sharing the room? I would appreciate it very much. So 2 people have shared the room. Let's get some more people sharing the room. All right. So now let's see how this was. Rodney says, you're welcome. Thank you. All right. So who does this benefit? Who did this benefit? I'm continuing to read here. I'm continuing to read this article. All right. This paper. All right. And the government established, okay. Thus, the invention of the fixed rate, self-amortizing long-term mortgage was above all else a response to a general financial crisis, as opposed to a design for the promotion of home ownership per se. What? Long-term mortgages was actually a band-aid to help us to get out of the depression. It wasn't created so that homeowners or home buyers could have an easier time of it and get a payment they can afford. It was an economic band-aid. It was pure economics. So let's continue to read this because I think you're going to like this part. All right. FHA adopted this form of mortgage to avoid the problem of people needing to refinance, which had clearly led to disaster. The combination of HOLC and the FHA represented a piece of early financial engineering that allowed, watch this, that allowed illiquid financial institutions to become liquid again. With whose money? With whose money? Okay, so here it is, another example of us thinking that these mortgages were put in place so that you can get a payment you can afford, where the government stepped in, buys up mortgages, and then sets them out on the secondary market so that they can get their money back, so that illiquid financial institutions can become liquid again through these mortgage instruments. How about that? Does this sound like a bailout to you? Yes or no? Yes or no? Does this sound like a bailout to you? Okay, Aaron Jones on Clubhouse is saying, "Thank you, Don, for all you do." You are so welcome, Aaron. I appreciate you for even being here today to soak up this information. And the replays will be on. The replays are on. You deserve to know, as consumers, you deserve to know the history of these mortgages. You deserve to know how they work. You deserve to know who they ultimately benefit. And it ain't us. Good morning, Tanae. How are you?
Good morning. I was going to get to my work for Sunday, but thank you for the invite up. This is an important subject because it's so funny. We think that 50 years is a long time, but it's really not. When did that, what'd you say, from World War II is when that started?
Well, actually, before 1936, we're going to find out that the first 20-year mortgage was created in 1936.
Wow. So that means there's only hypothetically 3 or 4 generations of people that could have paid off their mortgage.
Exactly. Not only that, but we're finding out the whole history behind this thing, and who benefits from this. The investors benefit. Not only that, but just before you came in, we went over. The investors wanted to get involved in this thing, but they wanted 2 assurances. Number one, how do I make sure that if they default, I get my money? In the same time, that's when mortgage insurance was created by the FHA. So they could ensure that the investors get their money. And then the second thing they wanted, how do I get my scheduled interest payments? The schedule was 20 years. How do I get my scheduled interest payments? Don't teach the people how these loans work and that they could actually get them paid off in 5 to 7 years. But if we don't teach them anything, they'll keep them from 20. You'll get your scheduled interest payments. You see, when I went through the entire article, I did not find where education for the consumers was any part of this whole New Deal to help get the economy back on its feet?
Well, I mean, there's always those disclosures that no one ever reads.
Right. Now,
So,
now you got
yeah.
you got the disclosures, but even the disclosures do not explain how the mortgages actually work. You see, here's what we're talking about today. You're a real estate investor, correct?
Yes, sir.
Okay, so I'm going to get into real estate investing. And I don't know anything about ARV. I don't know anything about cap rates. I don't know anything about 70% rules. I just have some money and I want to get into real estate investing. And you're going to say, what?
I'm going to say, if you don't know anything about real estate investing, I'd probably direct you to House Hack. So I'd direct you to, get your first home and buy a 4-family property.
There you go. So you're going to say, listen, Don, take it nice and slow. Here's some things that you can do. And we know how to, we spend a lot of time on understanding how to buy a property right. We spend a ton of time how to get it repaired correctly and how to rent it out correctly. Guess what? We don't know anything about the interest cost on borrowing money and how to effectively use that money for ourselves. The way that this thing is structured, the permanent 30-year or 20-year amortized mortgage is the most inefficient way to pay back money that the banks could get away with, but makes it look like we have a payment we can afford, but it is so expensive to maintain, where they can still make a lot of money. So that's what we're getting into today. Who does this thing ultimately benefit and why? All right, let's continue. Let's continue on. And Tanae, if you want to see this article, I put the link in the chat. All right, let's go ahead and put the link back in. So let me find out. And let me see here. I've got the link. We're going to copy it again. Copy and place it back in the chat so that you can read this article for yourself. Okay. You can also go on YouTube, and I have the article and we're reading it and trying to break it down today. So if you want to go on YouTube, search P.I.L.L method, and you'll be able to see what we're seeing on the screen. All right. Now, here we go. Let's continue on. Thus, the invention of the fixed rate self-amortizing long-term mortgage was above all else responsible for a response to a general financial crisis, as opposed to a design for the promotion of home ownership. All right. The next paragraph, the homeowners loan corporation, having performed its task, was disbanded in 1936. In its place, the Federal National Mortgage Association, the FNMA, Fannie Mae, which would be later called Fannie Mae, was invented as a government agency in 1938 for the purpose of abetting a secondary market in FHA mortgages. All right. And, when I saw that word abetting, I looked it up. All right. So I'm going to put it in here, abetting, ABETTING, abetting definition. All right. And so we're going to bring this over. And I love this first definition. Okay. It says abetting, encourage or assist someone to do something wrong, in particular to commit a crime or other offense. Listen, that's not the only definition, but it is the first one. And I think it is appropriate for today. All right. So let's get into this a little deeper. All right. In particular, FNMA, Fannie Mae, issued bonds for purchasing mortgages at par, so the investors in affluent communities could invest with confidence in mortgages in communities with little local capital. Now, what makes investors confident when they're investing? I need to get some feedback. What are some of the things investors would be looking for so that they can feel confident in doing what they're doing? Listen, folks, they're not going to invest if they're not fairly sure they're going to get their money back. They've done projections on investing and they're looking at what am I investing in for how long and what are my projections on the money I'm going to make? Come on. So they're looking at purchasing this paper from the banks and they're looking at these are 20-year, and when we read more, because I had to skip over some stuff. When we read more of this article, we're going to find out that these 20-year loans, they were looking at 5 and 6%. And the most they could get anywhere else was 4%. They're getting 5 and 6% on their money for 20 years. And the people who are paying these mortgages are unaware that they could easily give the money back to the lenders without giving them all of that interest. And I'm asking one more time in case there were new people that have come in. Have you ever had a class on how a mortgage actually works? Do you think while you're in high school and you're learning how to cook and you're learning how other things that you need to be able to adult properly, why isn't it being taught how banks make their money through interest? Why is that being taught? That you could actually do something about it to cut your interest costs by 50, 75, even 80%. You don't have to pay all that interest. Why aren't we being taught how a loan actually works? Let's dig into this. I'm digging in. And listen, there's more to this than meets the eye. All right? Because I have some other articles up here. So we won't be able to get to the whole thing. Maybe have to do part 2 and part 3 of this thing because there's just so much going on here. All right, watch this. Now, the thing is going to start to grow. The mortgage market changed little in the 6 years following the invention of FNMA, Fannie Mae. The Depression, the late 1930s and World War II were all times when the housing market had relatively little construction and few transactions. Watch this. At the height of the mortgage market before the Great Depression, in 1925, 937 new units were built. Okay. All right. After the Depression, this total fell to 93,000 units in 1933. From a high of 937,000 new units to a low of 93,000 units in 1933. And the 1925 peak was not surpassed. Okay, we didn't get back to over 937 new homes being built in a year. All right, was not surpassed or not even approached until after World War II. After World War II, that's when things really started to pick up. Now, what happened? What happened between the time the Great Depression and World War II? What happened? Let's find out. With the anticipation of the end of World War II came the GI Bill of Rights, officially known as the Servicemen's Readjustment Act of 1944, or the VA loan. The VA loan. watch this, okay? Because things are starting to come together. All right. Because see, there has to be a lot of things in place for investors who want to invest in these mortgages. And what happened as a result? Included within the GI Bill was the invention of the Veterans Administration Mortgage, VA mortgage insurance program, a program that allowed veterans returning home to obtain mortgages with very low down payments. Uh-oh. The program was intended both to reward veterans and stimulate housing housing market construction. Okay. Now, the Fannie Mae was still at the time a government entity at the time. And so what are we doing here? We got a government entity with this mortgages, and we need to build more houses because we need to make it more attractive for investors. And since I'm in government, now listen, this is not in the article. What I'm getting ready to say is not an article. This is totally me saying this. If I'm in government and I know we're setting up a system whereby investors can purchase this paper and get long-term benefits out of it, am I going to let my friends know about it? Am I going to get involved in it before it becomes public? I'm just asking. Can anybody, does this make any sense to you? Ladies and gentlemen, that the people who know what's getting ready to happen actually benefit from what's getting ready to happen somehow, through relatives or friends or even themselves, setting themselves up when they're no longer our public servants. Come on, ladies and gentlemen, what's happening here? So now we have hundreds of thousands of people coming out of the service, and we're going to make it easy for them to borrow money to build homes because we want to take care of our service people. That's how it is marketed. We want to take care of our service people. But then if they came home and wanted to they could easily get a mortgage, then what has to happen? They have to build houses, which is going to stimulate the economy. And those people who are in those industries who are making money through building houses are making money. Those people who are lending money are making money. And those people who are buying the mortgages are making money. But it's all paid for through interest on money that the consumer is providing, and everybody is getting educated on the process except the consumer themselves. The program was intended both to reward veterans and stimulate housing market construction. And I guarantee you, part of the education was not how the whole thing worked. At about this time, the Federal Housing Administration, FHA, also sought to stimulate housing construction by substantially liberalizing its terms. So the FHA liberalized their terms along with the VA loan so that more houses could be built, more people could get a house, and more people can get a mortgage and pay mortgage amortized interest for 20 years. At least for now. What happened next? In 1948, the maximum term of a mortgage rose to 30 years from an initial maximum 20 years. In 1956, the FHA raised the maximum loan to value ratio to 95%. Look at all these things coming together, ladies and gentlemen. The FHA raised the loan to value to 95%. So now you can get a bigger loan. And with a bigger loan, is there more risk? Yes, there is. But now we also have mortgage insurance, which reduces the risk. And now we're having these mortgages are being sold on the secondary market so that the institutions that are providing the mortgage money get their money back so that they can continue to provide more mortgages. All of these things are coming together, except education, except financial education. So what else is happening? All right. Of the 80% of the new construction, from an initial maximum of 80%, the new construction and to 90% for existing homes. However, the FHA did not retain a cap on the size of the loan it would insure. And in doing so, it allowed for private sector market in mortgage insurance to develop for high balance loans. So here comes not just the mortgage insurance from the FHA, but PMI, private mortgage insurance, comes into play. What happened with that? With the strong expansion of the U.S. economy in the post-World War II period, driving up incomes together with the new institution of long-term and therefore affordable fixed-rate self-amortizing mortgage, home ownership expanded rapidly. So we got all these ancillary and secondary businesses that are popping up. All right. Private mortgage insurance companies just took off. We had investors that started to buy up these mortgages, making more money. And now we have liberalized terms for people to get mortgages. And now it stimulates housing and the builders who are building the houses, all funded by people who are now making more money so that they can afford more mortgages to keep them for not 20 years, but for 30 years. Let me check and see if I have any hands raised. People want to come to the stage and ask some additional questions. All right. Am I seeing any? Am I seeing anything? I don't want to miss you. All right. So I'm not seeing any hands raised. All right. So if you're new and you want to see this, go to YouTube. I have it on the screen. I also have the link to this white paper that you can get. It's all there, and this was put together by let me see which page I'm on, 97, because I have to scroll back to the top. All right. Let's see here. Penn State, Penn Institution of Urban Research, University of Pennsylvania. All right. That's where this has come from. All right. There we go. So let's go back. All right. Back to page 97. All right. I wanted you to know where that came from. Let me see. 96, page 97. All right. So where was I on page 97? All right. The FHA was a key. All right. The FHA was a key to the transformation. Is probably okay. Here we go. With a strong expansion. All right. America was transformed. Okay. Here we go. All right. America was transformed from a nation of urban renters to suburban homeowners. Listen, was this for us? Was this for us? Kirk Nugent, listen, man, I see you're on camera here. Are you excited about this information? Kirk Nugent, folks, he's our our producer to make sure that you can see and hear everything. And I see he put a camera ready. Kurt, listen, man, interrupt me anytime you're ready to make a comment or ask a question, man. Okay. We actually love you being here doing this for us. Okay, so let me see here. Let's go ahead and figure out what's going on here. The mortgage was all right. Let me see here. All right. So America was transformed from a nation of urban renters to suburban homeowners. The ownership rate among U.S. households rose from 43.6% in 1940 to the last year before World War II to 64% by 1980. Okay. The FHA mortgage was key to this transformation. The FHA mortgage was key to this transformation, ladies and gentlemen. It was great that we have more home buyers, people who can buy their own home, but it was also great for the home builders. It was also great for the bankers. It was also great for the investors. It was also great for the private mortgage insurance. It was also great for all the people who are making money off our money. It was great for everybody. But we didn't realize that 4% or 5% or 6% didn't mean that at all. If you had a 4% mortgage, it meant that you're going to pay back 71% of what you borrowed in the form of interest because of how the loan is amortized. If it's 5% mortgage, you're going to pay back 93% of what you borrowed. So if you had a $100,000 loan for 30 years at 5%, you're going to pay back $93,000 in interest. So the person that bought that paper from the bank had a person who had a mortgage who didn't understand how it actually worked. And the investor says, not only do I have private mortgage insurance that you have to pay, so if you default, I still get paid. You really don't understand it. So I'm going to get my money for a very long time. That's the next thing. But if you should default, even though I got mortgage insurance, I still take possession of the house and I sell it again. One more time. Even though I have private mortgage insurance, I take possession of your home and I get to sell it and make even more money. Whew. That's what's happening. So, do we get a house? Yes, we get a house. It's about time that we, who are the very foundation of this whole system, begin to understand that we can benefit from the fully self-amortizing loan once you understand how it works. We can turn this thing around, ladies and gentlemen. You don't have to do it this way. All right, so let's continue. Let's continue on. All right, the FHA mortgage was the key to this transformation. Its profitability to the U.S. Treasury, its profitability to the U.S. Treasury, discussed in footnote number 1, included large-scale entry of the private sector, which developed the self-amortizing, privately insured mortgage. Self-amortizing, privately insured mortgage. And there was a ton of them out there. Self-amortizing. See, they'll tell me that it's called self-amortizing, but nowhere in the article does it help me to understand how amortized loans work against the consumer. It just says that it gives you a payment you can afford, which is true. But it also gives you a cost that is very expensive to maintain. at the same time. That's the part they're not talking about. All right. Over time, the private sector market, here we go. Private sector market share of mortgage insurance grew as it outcompeted the publicly insured provision of mortgage finance. FHA mortgage insurance fell from 29.4% of the market in 1970 to less than 10% in the mid 1990s. So private mortgage insurance started taking off. I mean, so who's jumping into this business? I mean, who's doing this? So if the businesses are taking over, people are jumping into this because we have a long-term loan. People are not educated as to how they work. So now we have a flood of people who do understand it coming in and saying, I need a piece of this market. I need a piece of this money. There are trillions being made. In my new book, I'm going to talk about the trillions that are being made through interest. I mean, it is obscene how much money is being made because we're not being taught how loans actually work. Obscene money. Together, the FHA and the private sector provided mortgage, which came to be called the conventional mortgage, dominated the market. So you have the FHA and the conventional mortgage dominating the market. Not only that, but you still have the VA loan, which is still very popular. Boom, working together. All right. So let's skip down here. Let's skip down a little bit. And the new on page 98 on this thing, and the new Fannie Mae, which would now be privately held. Okay, this is when Fannie Mae began to be privately held. All right, let's back up here. Let me go over to my notes. All right. All right. Okay. This I didn't highlight this part. Let's go ahead and highlight it for you guys. All right. Boom. Come on, Don. Get it together. All right. Highlight this part. Boom. And highlight. There it is. This arrangement began to show some cracks in 1966 when the 3-month Treasury yield rose above 4%. The deposits flowed out of savings and loans and into Treasury bonds, resulting in a shortage of funds for mortgage borrowers. One of the responses to this event was the 1968 splitting of Fannie Mae into two pieces of the Government National Mortgage Association, known as Ginnie Mae, and the new Fannie Mae, which would now be privately held and would be able to buy and sell non-government backed mortgages to raise additional funds for mortgages. Okay, so now we've got Ginnie Mae and Fannie Mae. Fannie Mae got out of the main mortgage business but stayed involved. Okay, Fannie Mae stayed involved, and we'll get to how Fannie Mae stayed involved. But now we have they're privately held now. All right, they're privately held, and so what we did was to stimulate so that we can get so that they can now buy and sell more mortgages. Listen, folks, people are making money off mortgages, just the paper. Okay, the government. Oh my goodness. The government is, listen, help me to understand this. Is the government the original wholesaler? I don't know. I don't know much about wholesaling, but is the government the original wholesaler here?
Can I ask you a question, Don?
Please do.
Okay, I've always understood the cost of money. And the cost of money is what it is because most of us don't have $300,000 sitting in the bank to go buy all cash, or $500,000, the average cost of property in the United States. So money costs, and everyone has to make money.
Yes, that's right.
Wouldn't you agree?
I would agree. I would agree to that. So, was that question leading somewhere?
Well, if everyone has to make money, I guess what you're teaching us is how much money everyone is making, and then how to basically cut that um, to a portion where it's in your benefit.
Exactly.
Correct?
Exactly. That's what we're
Yeah.
talking about here. Listen, if you're in, listen, when I buy tires, I want to get the best deal I can. You know, we had to go on vacation and buy new luggage. I want to get the best deal I can. When you're a real estate investor, you want to get the best deal you can. You don't want to, if you're a real estate investor, you don't want to pay retail. You don't want to pay full market price. You want to come in at 70% so you can actually make money on the deal. But we learned how to make money in every single part of the deal today, except when it comes to borrowing the money. We don't fully understand its cost and what we can do about it. There is a ton we can do about the cost, but we just haven't been taught how the whole thing works. So if I'm in the business today, if I'm in the business of the mortgage industry somewhere where I'm buying and selling mortgages, or I'm in a home building, if I'm in the mortgage insurance part of it, whatever part of it I am, do I want there to be more money available or less money available? Yes or no? More money available, less money available. What do you think?
More.
More money available. So if the more money is coming from the consumers who are paying the interest, doesn't it behoove those who want more money in the system? Doesn't it behoove them that the people who are actually paying the money know very little about how the system works? I'm just saying. All right. Aluja just came up to the stage. Thank you, Tanae, for watching out for me. Listen, you're going to be very helpful.
Later, so I got you back.
Thank you. I appreciate you. Aluja, do you have a question or comment about what we're talking about today?
Grand Rising. Not at this moment, just came into the room and here to support and learn more.
I appreciate you, man. I appreciate you. All right, folks. Listen, the replays are on. If you want to see what we've got going on here, all right, got an article. Go ahead and look it up. Follow us on YouTube. Subscribe to YouTube. Also, you want to be able to see what we got going on here. Plus, I've given you the article. I'm not selling this. I didn't write it. We're giving this to you. We need you to know the truth about what is really going on here. All right. So, let's see. Now, what happened next? All right. So let's see. In addition, by taking Fannie Mae private, the government was able to remove Fannie Mae's debt from its balance sheet. Congress created, who created? Congress created Freddie Mac in 1970 to scrutinize mortgages issued by savings and loans. The mortgage insurance function was kept inside the government through Ginnie Mae for two reasons. First, to continue to provide a full government-backed guarantee of timely payments of FHA foreclosed mortgages to the lender. Wait a minute. Ginnie Mae, the first reason, benefits the lender. I'm dying to see the second reason. To be able to package and securitize FHA loans. Ladies and gentlemen, where are we in this? Where's our protection? How do we benefit from? Yes, we get a house. We get a house where we have a very inefficient way to pay back loans So we're fueling the whole system with a lot of money. So if you have a 4% loan, you're going to pay back 71% of what you borrowed. A 5% loan, you're going to pay back 93% of what you borrowed. So if you have a $100,000 loan, you're going to pay back $93,000 in interest. If at 6%, if you have a $100,000 loan, you're going to pay back $115,000 in interest. If I'm a real estate investor, does that look pretty tantalizing to me? If I'm a real estate investor, I get $100,000 and invested, I get $115,000 back. Come on. Not only that, but along the way, I'm getting huge interest payments along the way, where when an individual gets this mortgage and they make their payment to me, 75 to 83% of the payment that they make comes to me as the investor. It's called interest, where the other part pays down the principal. 75 to 83% of because it's amortized in the early years comes to the, so the investor doesn't have to wait the full 30 years to make a ton of money. We're going to get into this. I'm going to show you exactly what's going on and what we have not been taught about how this whole thing works. But I got to give it to you. I got to let you see here for yourselves that nothing in here about how the whole system works is the protections are not there for us. The protections are for the investors. Congress's intent with the creation of Ginnie and the new Fannie and Freddie was, at least in part, to ensure the mortgage liquidity problems of 1966 would not recur. Come on, people. We're still left out of the box. It's mortgage liquidity for the institutions. All of this was in place for that. Because listen, if there's nobody buying, if there's nobody selling, there's nobody buying. There's nobody buying, there's nobody selling, and nobody can make money. You have to have, where's the foundation? Us. Because of all of this happening, wages in the United States began to rise. People began to be able to buy more house, and they could get it with 3.5% down and pay all these mortgages forever. Okay. And with these big, huge mortgages that were insured by private mortgage insurance, the private mortgage insurance companies were making a ton. And then so that the people who were purchasing the paper felt secure in the fact that they could get that money. Ooh, watch this. So I'm going to get that money. What else is going on here? All right. I think this is as far as I decided to go today. All right. I need you to see that Congress is involved. So who's telling their friends? Congress. Now, this is not in the article. This is me talking again. All right. So when there's business to be done, when there are trillions of dollars out there that are being generated and the government is involved in this. All right. I'm going to tell my friends, get into mortgages. You know, when the oil industry discovered that the stuff that they were throwing away could be turned into plastic. In the earliest, people said, get into plastics. Okay, get into plastics. And now, as we're coming out of the Great Depression, and this thing is made to prop up the U.S. economy, where we're taking people from renting into buying, all of this money is being generated and somebody's taking advantage of it, and it ain't us. So let's get into it. Let's get into what's going on here and let's take a look at the percentages. All right. In the last 45 minutes of the show. And then maybe we can get into it a little bit more. Oh, wait a second. I forgot. I want you to know we're made to think that this thing is really simple. All right. I need you to see something here because do you realize I need you to see what this is? The Journal of Mathematical Analysis and Applications. You know what this is all about? This is what explicit formulas for pricing callable mortgage-backed securities in a case of prepayment rate negativity correlated with interest rates. I want to show you. I don't even understand all of this because it's just it's a lot of math and it's hard for me to get it. But here's what I do know. There's a lot of math behind buying up these mortgages and calculating what are the possibilities of these loans being prepaid so that I don't get all the interest I'm looking for. And do you know there's a whole science behind this thing? Look at these numbers. Look at these formulas. There's a whole science behind predicting how many of these loans will be prepaid so that I can go ahead and invest my money to ensure I can make a ton until it's paid off, or until it's paid off in its full term, or it's paid off prematurely. I've got formulas here that's going to help me to determine whether I want to be in this business or not. We think it's simple. Just pay extra. Just pay more. When the whole industry is based, look at this stuff. I can't even begin to understand it, but the folks that are involved in this thing, they're looking at this and saying, based on what I'm seeing here, chances are this loan is not going to be prepaid in time enough for me not to make money. I'm going to make my money based on the calculations. This math works, ladies and gentlemen. The math works. If the math did not work, you would not be able to get loans with low down payments, 3.5% to 10%. If the numbers did not work, invite as a speaker, Steve Mack. Come on up, Steve. Listen, it's not simple by any stretch of the imagination. It's very complicated, but we're told it's simple because when it's simple, when you don't do stuff that is at this level of intricacy, we're not going to get full benefit. We're going to pay more interest than we need to, which is going to fuel this fire. We are paying the money so that other people can get rich. And we should be able to get rich on this thing ourselves once we understand it. So I just want you to know this is just one article. Here's another one. Microeconomic driven prepayment risk and the valuation of mortgage-backed securities. Folks, there's so much out here for people who are in the business of selling us mortgages so that they can make a lot of money. But we're told it's very simple. You really don't need a whole lot of education to go in and sign a document that says you're going to be able to get a home, pay it back over 30 years, and your family now has a house. We don't know that most of these mortgages can be paid off in 7 years without disrupting our finances, without having to sacrifice lifestyle. We can pay it off in 7 instead of 30. All right? That's what's happening. So, Steve, did you have something you wanted to say this morning?
No, sir. Just hi to everybody and yourself, and just came in to support. That's all.
Thank you. Brought Giuseppe to the stage. Giuseppe, do you have anything to say this morning? We're talking about the mortgage industry and where it came from and who it benefits. Oh my goodness, Listen, the amount of information we don't know about how this works, folks, will fill an ocean. Will fill an ocean. How much money is being made here? And we don't know that we are. Listen, are you familiar with the movie The Matrix? In The Matrix, all right, the whole movie is about people who are being used to create electricity for the machine world, but they think that they're living their lives, they're living their best lives while they're in little pods and being used as batteries. Folks, in this system, we're in the mortgage matrix, and we are made to think that we're doing well when we're interest generating machines for our entire lives. We're told, why rent when you could buy? But we go from renting the entire house or the entire apartment to renting the money for our entire lives. Rent is rent. Let me show you what I'm talking about. So let's put this back over here. All right. And let me bring back my amortization schedule. Boom. All right. I'm going to show you something that's simple here. $200,000 at 7% interest, because that's what it is today. Excuse me, as high as 7.5%. And we're going to take a look at this. 200,000 at 7%. The payment, principal and interest payment, is $1,330.60. Folks, I don't care most places where you are, to rent a house like this would probably cost more than $1,330. So what you're being told is, go ahead and buy the house instead of renting and making your landlord rich. So here's what's happening. I go from renting the house to now I'm going to rent the money. I am now renting the money. Let's break this down. On a $200,000 mortgage, here's the total amount of interest that not the bank is going to make, but the investor who buys the paper from the bank will make. $279,016 on a $200,000 loan. That makes it a total interest paid as a percentage of principal 139.5%. 139.5%. That's what's going on here. This is what's driving this market. Trillions of dollars are being made. I mean, there are 100 million mortgages or more paying this kind of interest. Look at this. On the very first payment, I'm a real estate investor. I bought this paper from Wells Fargo. And when somebody pays me my $1,300, 163 of the dollars goes to pay down the principal of the loan. But look what I get. I get $1,116.67. And look at these, but every month, because the principal goes down, every month the amount of interest that I get goes down. But let me show you something. Because here's how I want to make my money. I got my money invested in this thing, right? And so my total payment is $1,330. Okay. Total payment is $1,330. And my very first interest payment is $1,166.67. Remember, I just bought this paper. I just showed you the whole history here. Okay. Here's what's happening. I'm going to divide this by my total payment of $1,330. $1,330.60 equals 87%. 80% of the money that's paid comes to me in interest as the investor. Okay. Now, Tanae, I do not want to tell people that I don't want the investor to make money. I do want the investor to make money. I want the banks to make money. I want everybody. I want the builders to make money. I want the people who are working for the builders to make money. I also want me to make money. Okay? As the home buyer, I want to make money too. Everybody's making money but me. As the person who is buying the home, who's paying all of the interest, everybody can win here. Let me show you what else is happening. Okay? So 87%, that means out of every dollar, folks, the way this thing is set up, out of every dollar, 87 cents of that dollar goes to the investor, and 13 cents out of the dollar goes to your purchasing back your equity. Because see, when the bank buys your gives you a loan, they're actually purchasing your equity, and you're purchasing the equity back from them a little piece at a time. Here's where your principal payments are. In the very first payment is $163.93. In the first 12 months, it goes to $174.76 as you're purchasing back that equity a little piece at a time. But here's how much it costs: $1,166, $1,165, $1,164, $1,163. This is how much it's costing you each and every month to buy back a little piece of your equity. I want to know, ladies and gentlemen, do you think this is too much to pay for your equity? You tell me, yes or no. Do you think this is too much to pay for your equity? Now, I'm not anti-bank. I like the bank, but I also want everybody here to understand the history of this thing and what is actually going on behind the scenes. And we're going to dig deeper into the history. Please don't. We're not even done with learning what we need to learn about this. All right. Some people are saying, yes, it's too much to pay. Yes, it's too much to pay. So in the first year, I need you to watch this now. Here's what the real estate investor is seeing. The person who buys these mortgage-backed securities, who's done the math on what happens if they should prepay? What is the likelihood of them prepaying? They've got supercomputers that figure all of this stuff out for them. And they say, you know what? This is a good bet. This is a good bet for me to get into this thing. And they get into it because you could prepay, but you're not. And the reason why you're not is because we don't understand it. We don't understand it because it's not being taught anywhere in financial education, anywhere, not even at the Wharton School of Business are they teaching. It is not even a part. What I'm showing you right here is not even a part of this article. You would think that how the loan actually works would be a part of the article, wouldn't you? I'm just saying, how did it get left out? So I'm just asking here. So in the first year, you're gonna buy back $2,031.55 of your equity. That goes to your equity. But guess what you pay for it? $13,995.65 that goes to the investor who bought these securitized mortgage products. They're going to count on this money. And they don't have just one of them. They have several of our mortgages. They're just buying them up because that's all they do. They take their money and they buy up mortgages. Bernice, who is watching us on YouTube, says that is just too much to pay. So this is what you buy. You're buying this, but you paid that. This is in year 2, $4,000, but it costs $27,000 to get it. Your $4,000 in equity. In year 3, you paid this loan down. You paid all of this money out and you paid off $6,500 of your loan, but it cost you $41,000 in interest. And the real estate investor who bought the paper doesn't just have your mortgage, but they have several others as well. They're making this kind of money where they're getting 80% ROI in the first years. Lord have mercy. Can you imagine? 48 months, 60 months, 5 years in, look at this. You paid off this loan by $11,763, but look how much interest has gone to the person or business that bought your mortgage along with hundreds of others. This is the kind of money they're making. And they think it's a good bet. Why? Because way back when in the 1936 and 37, 38, in those early years, here's what happened. They made it easier to borrow. They made it easier to borrow with little money down. They made it better for the investors because they gave them the private mortgage insurance began to take over. And they've also done the math on the fact that you're not going to prepay to save yourself money. So listen, it's 2 minutes after. Let's do a quick reset, and then I'm going to ask another question. You are in the Mortgage Syndicate this morning, and my name is Don Daniel. I'm the founder of P.I.L.L Method International, and P.I.L.L Method stands for prepayment of principal, isolating the principal amount, leverage, and liquidity. And we're dedicated to making sure people all over the world understand how these loans actually work and how they can cut their interest costs by 75 to 80% and be able to pay off their mortgages and other loans in about 7 years. That's why we are here, to tell the truth about lending, because it's not being taught anywhere else. Okay? I need you folks to go ahead and start inviting some other people in, because now I'm going to show you some simple ways to save money. Now, I told you before where the system has supercomputers that do the math so that they can make money. And we're given a dime store calculator and a pencil and paper and say, it's so easy for you to pay off your mortgage. Listen, 90% of the people you know will never pay off a mortgage. Over 90%. We're in a system that we're designed to fail at. Okay? 35 to 39% of your take-home pay, do the math, 35 to 39% of your take-home pay pays interest payments alone. And that's for well-to-do families. We're in a system where we're not batteries like the Matrix. We're interest-generating machines. So banks set this thing up so that we can pay as much as we can for as long as we can for this money. You go from renting a house to renting the money to buy the house for your entire lives. Interest generating machines. How many of you want to know how to get out of that? All right, before you go, I need you to understand this. We're going to take a little break here. Get a savings and earnings report today so you can know how much interest you're paying and how much interest you could save. Get a savings and earnings report today. Go to ice10k.com and get a savings and earnings report today. You can get it for free. A savings and earnings report. When you go to ice10k.com, you'll see a button that says get a savings and earnings report. When you're filling that out, ladies and gentlemen, then when you need to put in a cell phone number so that we can verify that you're not a robot. When you do, make sure there's no spaces in there. We provide the +1. Jam your cell phone number right up against that +1 with no dots, no dashes, no spaces. And when you click confirm, you'll get a code sent to you as a text message. Take the code, put it back into the website, and then you can click on that button down there at the bottom that says, yes, I want to save. And when you get that, then you'll be led into a financial form. Fill out the form, and for the first time, you're going to know how much interest you're supposed to pay and how much interest you can keep from paying the bank. And because of the interest savings, you can be out of debt in an average of 7 to 9 years. That's the average. Some are paid off a little sooner, some a little longer. All right. But folks, it's not 30 years of these expensive interest payments when we're led to believe that the payments are cheaper than mortgages. So go ahead and buy the house. I'm not against buying the house, What I am against is paying retail for the money when you could easily get it at wholesale. We have a cloud-based AI computing system that does all of the math, that guides you, that tells you exactly what to do and when, how much money to move, what month to move it in, what day of the month to move it on, which loan to attack, so that you can optimize or save the maximum amount of interest that's mathematically possible for you, so that you can pay your loans off early. If you can keep from paying that interest to the bank, then more of your money goes to principal, which pays off the loan. So it's not about how fast to pay off the loan, it's how cheaply you can pay off the loan. That's why we're here today, to learn this. So, ladies and gentlemen, I need you to see this. All right. So get the savings and earnings report. Also, get my book. This book is the only book on Amazon or anywhere that even begins to talk about this information. You can go to my link on my 10K card, which is ice10k.com, and click the link to get the book as well. Let's put that one up. Let's put the book up. So get the book, get your savings and earnings report, and find out how you can get your own opportunity cost calculator so that you can pay the least amount of interest, not only on this mortgage, but for every mortgage and every other loan for the rest of your lives. You can do that. You don't have to pay. You can borrow money like a champ. You can borrow money at a discount. You can undo what the banks have done for you. In fact, you need to hear this. In fact, you can save so much money in interest that you don't have to pay. We'll track it for you. And if you choose to invest the money that you didn't pay, you'll be able to earn back from the banks, from the banking institutions that pay compounded interest. You could take your money and invest it in such a way that you can earn more money back than you've ever paid in interest in your entire lives, if you do this thing right. And we'll show you how to do it. All right. Has anybody else raised their hand and want to come up to the stage? I don't see any hands raised. All right. So here's the next question, folks. Do you want to know the basics of how you can turn this thing around for yourselves and understand why you were never taught how a loan actually works, so that there be so much money generated that it would support all these other businesses off the sweat of your brow? The money that you earn. You've been turned into a natural resource. We all have. Would you like to know right now? So put a number 9 in the chat if you want to know how to turn this thing around. Put a number 9 in the chat if you really want to see what this is about. Put it in. I want to see it online. If you're watching us online, put a number 9 in the chat if you want to see how all of this works. And if you're new to the room, go to YouTube so that you can see the numbers. Search for P.I.L.L method in YouTube. Search for P.I.L.L method in YouTube. And you'll be able to see the live. Go, you get out your secondary phone or your laptop or your tablet. You can see the numbers. And I'm going to break down for you why this was never taught, not to you, not to your accountant, not to your real estate agent, not to your mortgage professional that sold you the mortgage. It wasn't taught to anybody, anywhere, at any time, how this works and how you can save money. I'm going to show you today. Tanae, thank you for putting the link in the chat. All right. So if anybody wants to come to the stage and ask a question, please do. I see Sean. All right. Let's bring Sean up if we can. All right. All right. Let me see here. Invite to speak. All right. So we sent you an invitation. All right. And we got some other folks up here. All right. So Sean, what's going on?
Not a thing, sir. Just glad to be here.
All right.
Enjoying a clear and sunny Sunday morning. And I got my pen and my pad out. I'm learning. I always feel like I'm getting the best education I can in your room. So please continue.
All right. So JB says, does the same method work here in Canada? It most certainly does. It works very well in Canada. In fact, it works even better in Canada than it does here. Do you know why I say that? Because with mortgages in Canada, even residential mortgages, there are prepayment penalties. I'm going to show you in your mortgage that even has a prepayment penalty how you can save money and interest by prepaying. And even if the prepayment penalty is triggered, you still save a ton of money because the penalty is so small and the amount of interest is so that you can save is so huge. Anybody would make that trade. So it even works better in Canada. All right. So I see some number nines online. I see some number nines here in Clubhouse. Let's get into this. All right. And if I could get somebody to help me, that would be even better if they could see this.
Were you able to hear me?
No, I was not.
Okay, I figured since you didn't respond, nobody heard me. I said I'm glad to be here. It's a sunny Sunday morning, and I always feel like I'm getting the best education in the world when I'm in your classes. So please continue.
Oh man, thank you so very much. Where is here?
Buffalo, New York.
Buffalo, New York. It's sunny in New York. Okay. It's also hot in New York. I was just came through New York coming from Jamaica.
It has been the past week or so very hot.
Yes. It was hot. So thank you for being here. You are certainly appreciated. And if you have a question or comment, please chime in. Ladies and gentlemen, let's get into this thing. I've got about 16 minutes left, but we're going to dig into this thing at another time so we get more history and more information. In this very first payment, is there anybody in Clubhouse? Is there anybody in Clubhouse that's seeing this that can also speak back to me? All right, please flash your mic because I could use your help. Anybody? Hi, Tanae. Okay, Tanae. Listen, Tanae, help me out here. All right. In this very first payment, how much money goes to principal?
Well, actually, I'm pulling it up because I have it on two different sections of my phone, but I'm going to pull up on my laptop.
Okay, thank you for that. Okay, so she listen. She learned how to do this on her phone, folks. You can have it in two different places on your phone. It's amazing how that works. But anyway, got $163.93 going to principal. $1,166.67 goes to interest in the very first payment. We're going to say that this first payment is in January. I made my first payment in January. Now remember, P.I.L.L method stands for prepayment of principal, isolating the principal amount, leverage, and liquidity. We're going to go over what happens when you prepay. Okay, so Tanae, you there?
Yes, sir.
All right. Have you got it up on your computer?
I sure do.
All right. So here's what we're looking at. All right. So we've already gone over payment number 1 in January. So if I'm in January and I have this schedule, I can actually see February's principal payment, can't I?
Okay. So you're saying it's January. Okay.
Payment number 1.
You're asking me if you can change okay. Ask the question one more time. I'm following along. This is the first time I'm following along.
Okay, great. Can I see February? I can see February's principal payment, can't I? How much is it?
$1165.70.
That's the interest payment.
Oh, okay. The principal payment for the second payment would be $328.82.
Okay, look at the very first principal. You're looking at cumulative principal.
Okay, you said February, and I couldn't see where it said February. Okay.
Yeah, so you've got the payments numbered way over to the left.
The first payment is $163.93.
Right. Mm-hmm. All right, and February's principal payment would be.
So you're seeing February, but
no, I'm saying I'm looking at payment number 2.
Okay, you're assuming one is January.
January, yes.
February. Okay, I gotcha.
You got me? All right.
Yeah.
So payment number 1 is January. Okay. Payment number 2 is going to be February. So how much is our principal payment?
$328.82.
That's the cumulative principal.
Oh.
Okay. You got 1, 2, 3, 4 columns. I got principal, I got interest, I got cumulative principal, cumulative interest, principal balance. So I'm looking at right 164.89. So based on what you know to be true today, do I have to wait till February to give the bank that 164.89?
I never thought about it, Don. I never thought.
No, you don't.
Okay. No, I don't. I don't have to wait because I can actually prepay, can't I, Tanae?
You can. There's no penalty because it's not more than 20%.
Right. So I can prepay that. So if I give that money to the bank in January, you realize all of that money goes to principal. And if you look at the principal balance in January, I'm paid down to line 2 on my principal balance, which is column number 4. 1, 2, 3, 1, 2, 3, 4, 5. Column number 5. Principal balance is $199,671.18. That is, I'm paid down to that amount in January, correct?
Yes.
Which means my next mortgage payment for February is actually on what line of the schedule?
3.
So it's line 3.
Line 3. Okay. So what just happened? So my next mortgage payment is based on how much I actually owe. I don't owe the $199,836 on line 1. I owe the $199,671 on line 2. And the bank has to use this number to determine how much interest I pay, which gives us these two numbers on line 3, which means the payment for March actually moves up 1. Payment number 1 is now touching payment number 3. Payment number 2 has been totally eradicated, eliminated. I've just turned 360 monthly payments into 359 monthly payments with just $164.89.
I think that's the magic of what you teach, Don. Every time you do that, you erase a payment, and it's incredible how it affects the total.
Exactly.
So, Don, when you call the bank, you say you want this to go, hey, I want this to go to principal.
Only if you have escrow, if you're escrowing your payments. But if you're not escrowing, it can only go to principal. You don't even have to do that. Any extra money has to go to principal. Yep. Once you make your full payment, even an extra dollar goes to principal, if that's the only place it can go. And if you're escrowing, most banks will default and put extra money into the escrow account. That's just their default. They know what you want, but that's the default. So you do have to find a way to let them know. So, but you're right.
I thought that their default was to pay their interest off first.
Exactly. And that's why when you pay extra, they said, let's put this over in, because they didn't tell us what to do with it. Let's put it in the escrow account so we can continue to make interest.
Got it.
Okay. So if I prepay this, because Sean has been here before. Tanae, if I prepay the $164.89 on line 2, what happened to the interest payment of $1,165.71 on line 2? What happened to that?
I guess it's gone.
It is gone. For $164 invested in my mortgage, I just saved myself $1,165.71 in interest I don't have to pay. So if I break it down this way, if I'm buying my equity back and it costs me this much money, if I give the bank the $164.89 early, did I just get my equity for free? Tanae?
You did. Absolutely.
I did. What if we did this, Tanae? All right. I make my very first payment here in January, and I got a few ducats in the bank. I can find, and my bank account's paying me what, 1/10 of 1% interest. I could prepay the 164.89, the 165.85, and the 166.82. The next three principal payments. You see that? So line 2, 3, and 4. What happens to the interest payments on line 2, 3, and 4? What happened to that money?
It's gone.
It's gone.
Have-
Go ahead.
Do you have to be very specific according to the amortization schedule? For instance, sending a specific payment that is equal to the payments they're expecting?
Not at all. Not at all. I just do this because, for teaching purposes, because you can pay $1. You can pay $10. You can pay $25. Okay. So Tanae, if I could take 164.89 and save 1165.71, what would happen if I cut that in half? 164.89. So let me put my calculator on the screen. Okay. 164, okay, 0.89 divided by 2. Okay, I got $82.49. What if I only gave them $82.49 today? That's half. Would I save half the interest here?
I'm not sure, Don.
You would. You'd save half the interest. How about that? Isn't that great to know? So I got my 1165.71 divided by 2. I can save, with that much money, I can save $582 in interest I don't have to pay. If I divided it in half again, I would save half the $582. So however much money I pay, the reason we don't do it is because we have no idea how much interest we're saving when we do. So as long as you've been in real estate investing, has anybody ever pointed out what happened? You can prepay, but have they ever pointed out what happens when you do?
Absolutely not. I've only heard about the 2 payments and
Right.
Okay, make 2 payments and then that'll, take off like 5 years of your mortgage. I've heard people talk about the 5 and the 7 year, but I never saw it explained. So I really appreciate this.
All right, good.
I think it's important to point out too, like usually when it's taught, it's exactly what you said. They teach you to make double payments that equal the entire amount. The way you're explaining it, if you add an extra $169 to each payment, you are basically making double payments at that time instead of the entire amount. So instead of $1,200 times 2, you simply add another $169 and it equates to 2 payments on the amortization schedule. And that is powerful.
That's what I'm talking about, ladies and gentlemen. I'm going to show you this last thing and we got to go. All right. We're going to come back. We're going to show you more history and more numbers at a later date when we go over this subject again. But you've got the replays here. I want to show you this one last thing. Tanae, we got 1 year into this mortgage. 1 year into this mortgage. I'm now looking at column number 3. Add up all the principal for 1 year comes to $2,031.55. Okay, that's all the principal payments added up. Column number 4 is cumulative interest. That is all the interest payments added up. So for in 1 year, I pay this loan down by $2,000, but it cost me nearly $14,000 in interest to do that. Tanae, are you seeing that?
Absolutely.
So here's my question. Do I have to? I know I've got to pay them the $2,000, but do I have to pay it in 12 monthly installments?
Got it.
Can I give it to them all at once on line 1?
I see. So the cumulative principal has to be paid. Let's see. Principal, cumulative principal.
Right.
Okay, that's being paid. Yeah, yeah.
Hmm.
And then you're saying, okay, so you would just pay the 2,031 and 55 cents
Right.
day one,
Right.
and then that's going to take out 14,000 in cumulative interest.
Well, let's take a look at that. So I've got so I got $200,000. $200,000. I'm going to subtract $31.55 equals 197,968.45. That's exactly what I have on line 12, isn't it? How about that? So if I prepaid that, what would happen to all the interest between line 2 and line 12? Tanae?
It'd be gone.
It'd be gone. That's a $12,779 worth of interest savings. I can be paid down to line 12, not for $13,009, but for only the $1,166.67 on line 1. Big difference, isn't it?
That's human.
Do you
That's humongous. When I think about underwriting on our multifamily deals, and we start applying this, as long-term hold investors, this could be very powerful.
do you see why it is not taught in school?
Yes, sir.
Ladies and gentlemen, thank you for being here today. I got to get out of here. We got to be done in 2 hours. But listen, stay here on Clubhouse. We got to let everybody else online go. Let's get the last word from Dr. Eric Thomas, and I'll see you guys again on Wednesday. Thank you for being here. Bye-bye.
Listen to me, y'all. But one of his mentees took us through one of their programs, and I paid off my mortgage. But guess what happened? My marriage went to a whole nother level. And you know why? Because my wife is a security freak. And even when I blew up, my wife would be like, oh, you blew up, but how long is you gonna keep making this kind of money? I was like, I don't know, forever. She's like, you sure? Because I'm gonna keep my license as a nurse just in case you don't. So when I paid the house off, my boy was like, you ain't gotta do that, you can do this. But when I paid the house off using that program, it took the stress level all the way down for my wife because we no longer had a mortgage. Does that make sense? That thing that was coming every month, that was getting on her nerves, we didn't have that no more. And so she was at rest.